All right, this is week 13, outlook number 2. I have not been looking at the charts too much. It's basically chop city, but let's review the price action beginning with the British pound futures. All right, so from the 4 hour, what we discussed last time was the draw on liquidity of this previous liquidity point here that's inside of this current price leg. I said I was very skeptical that price would take this high based off of the price action uh, the structural action here, which was the liquidity draw, and you're starting to see, based off of the last 2 days of price action and today just closed, the response to the liquidity draw. So there is still a little bit of bullish sentiment or bullish pressure that tried to battle in the premium side, but you're seeing that ultimately right now it looks like the bears are winning. We've drawn closer towards equilibrium, where we actually did touch equilibrium of the price leg here at this point, and now we're looking to dive lower. I'm looking in this area for potential retracement, and that's just based off of looking at this wick. This just seemed interesting to me. It may be something on a lower time frame, but I'm not going to go into that. Just based off of the 4 hour price action, the bears are holding strong. The structure is holding. That we're looking for continuation to the downside as of right now. I don't expect price to continue higher, but if it does, well, we'll just look and analyze to see how price is going to respond. Moving on to gold. All right, so gold is a little bit different. Gold decided to forego taking out the bottom of the range or taking out this liquidity point. It decided to retrace, which is totally fine. Why? Because we're inside of a range. So we're not trying to predict price action, we're trying to respond. And we're just analyzing or marking out the ideal liquidity points or the unmitigated liquidity points inside of the range and also the areas of interest so we can frame up the narrative and where and how price action is going to move forward from there. So as of right now, the price action has shown that we've respected this liquidity point and basically generated, uh, relatively equal lows here by this low not mitigating this low here, and that led to the pullback, which is a little bit higher in the discount side of the range. If this is looking to go higher, if there is no area of interest in this area here, then the target that we would look to see price move towards would be actually this high here, which is the last liquidity point that exists inside of this range. The only other option would be seeing if there is any inefficient pricing, any price gaps inside of here, but it's unlikely. And because we're in a range, I'm more inclined to look for price or structural responses at or structural actions at these liquidity points rather than looking for mitigation of a area of interest, especially because there these inefficient pricing between this wick or between these wicks, between these wicks, and between these wicks. Well, these two have already been mitigated, and it seems that we have an act, or we seems that we're having a response here. But this doesn't seem like a very valid. This isn't valid to me because it does not it's not a part of a mitigation of a previous price gap or a structural action. There's no liquidity draw. There's really no break of structure. I mean, we do break structure here, but there's no liquidity draw that led to the generation of this. If this candle here, if this price gap existed below the break of structure, then I would be more inclined to look at it. But if I was to use this, I would really want to see a previous price gap be mitigated, and this run here did not mitigate 50% threshold of this price gap, so I would not really look for this to hold if it does give some sort of response. As of right now, there is a mitigation of this price gap, and we are getting a response, but that's not really, you know, I don't expect that to hold. I would really like to, I would say that probably price is going to move towards this liquidity point. That's where the liquidity is going to be, and that's the liquidity that actually led to this move here. And so if price failed to take out this liquidity point that is marked here, then it has to go refuel, and the refueling station is at the high of this liquidity point. All right, so that's what we're looking at on gold. And so, like I said, we're in a range, so we're just chopping it up right now. Not too much to look at. NASDAQ, similar sentiment, right? We have the mitigation of the previous price gap. And so similarly to what we just talked about on gold, but we actually do have here is that this liquidity draw is what led to, break of this low here. And ultimately, this low, but this is really the price action here that led to the break of this low. But this low right here is what led to the high being taken here. And so this is the more important low that got broken. And as you can see, this price gap technically existed, or the portion that we want to mitigate, which is 50% to 100%, existed before we mitigated this low here. And so because of that, you can see that's what led price to pull back and not only take this high here, but we also mitigated 50% of that price gap, and then that balanced this essentially area here. You can see that wick is basically balanced by that wick, which is a part of mitigation of this price gap 50%, and that's what gave the response that we have now. And so I said before that we would be looking for price to pull back or start moving lower, and with the target being this low, and also remembering that we are inside of a range, right, which exists from this structural point here to the all-time high. And so we are on the discount side of the range, so I'm not really going to look for, at the moment, sells, because we are in discount. And the only thing that I would look for as of right now, I would have to be like extremely certain if I wanted to get a really good sell position, is for price either for one to pull back and mitigate, the high here, or pull back and mitigate this high, which is pulls deeper into the premium side, or we have like a clear, action of a break of structure, and then an area of interest that's generated as we move deeper into the discount side of this range. But as of right now, this is just chop city. I keep saying that, but it really is. It's just consolidated price action, and there's nothing that I want to risk inside of this area. There's no clear, um, entry mechanisms that I can use to get inside of this move. There's only the price action from the macro perspective, which I just detailed, that's showing us where price is most likely to draw towards. All right, moving on to the Dow Jones. Exact same structure here. We're actually bearish on Dow Jones, so this range no longer exists. From that low to that high, we broke this low here as well. We have the liquidity draw there. That got mitigated. We have that liquidity draw. That got mitigated. All right, so now effectively, we are in a bearish run. So because we're in a bearish run, what we should be looking for is the price leg that was generated. So from this high down to this low. And why do I say from that high down to this low? If we take it, we see high, low, high. This is the high that led to the break of these lows there. So that's the high of the price leg. Then we have low, high, low, high, low, which is this is all part of the impulse. And then once we broke this high right here, that solidified our price leg. And so now that right there is a break of structure. And it's a break of structure to solidify the pullback of this price leg. So now my price leg exists from this high right here down to this low here. All right, and so because we have that now defines my price leg. Rewatch that if you don't understand what I just did there, but that is the definition of how I define price legs. And then once we got that there, now because we're looking for sells, because the macro perspective bias is a bearish run, what we want to look for are areas of interest inside of the premium side of this price leg, or effectively the origin of the move, which would most likely be this price gap here, or if there is no area of interest, then we would look for price action to take out previous highs or take out previous lows, and then give us, a response or area, and generate an area of interest so we can continue the price action lower. That is the analysis for following the bias. The counter analysis is that this price action ends up failing, and then we start to move higher. And if we move higher, okay, it is what it is, and then we'll go from there. All right, so that's Outlook 13, week 13, number 2. Peace.